All right, welcome Tyler Bliha to the studio. Thrilled to have you here. Thank you for doing this.
Yeah, thanks for having me.
So I'll let Tyler give you his own background. He's the founder of Abode, a startup that I am very excited about and had the pleasure to do a little work with over the years. But also has the honor of probably being, I would guess, the upstart client that I've known the longest in life. As we met, I want to say we met probably in grade school at various like golf events and NBA select travel basketball type of things,
Right, that's right.
right? And you were much better than me at both of those things. But we've had the same, you're a year ahead of me in high school and at Notre Dame, and taken some similar paths to get into the founder seat now doing very different businesses. But I'm excited to, talk a little more about your journey and what you're doing now.
Yeah, so I guess we'll start there. We obviously grew up in northern Indiana, Granger, Indiana, which I very much miss. Um, Found my way to Notre Dame, as you mentioned. I was a business major, specifically finance. After graduating, I did the whole investment banking track out in New York at Bank of America, Merrill Lynch, um, and then moved to Chicago to work at Madison Dearborn Partners, private equity firm that does. I was investing in a lot of their SaaS and business services. Um, MDP does a lot of the industrial healthcare, fintech.
They're very big, one of the largest, most successful ones in Chicago.
Yeah, and that was a great experience for me to kind of like thrown in as a 25, 26-year old working with CFOs of major companies, and definitely felt like I was not prepared to do that work, but you kind of get drinking from the fire hose, and it's a great learning experience. It was my first introduction to how companies work, because you don't necessarily get to see that on the investment banking side.
Yes.
And then that set me up to go to business school. I went to Harvard in 2018, where I kind of went knowing I wasn't going back into private equity. I had a great experience at MDP in private equity. It just like wasn't what I was felt like I was born to do. I wasn't getting up in the morning like excited to go and do that, and I had interest in kind of like earlier stage. So when I was at HBS, I spent some time in venture out in New York. That is what kind of opened my eyes to the fact that I think in order to be a good investor, you need, like especially at the early stage, you kind of need the empathy. You kind of need to be an operator in order to be a good VC, in my opinion. And
Totally
so,
resonates with my experience, by the way. We can come back to that, but yeah.
yeah, yeah, yeah. And then my startup journey began when I joined as the first employee of a YC-backed startup called UpEquity. They at the time were they and still are looking to automate the underwriting process behind a mortgage. So intro to early stage startup, intro to fintech, and intro to like real estate adjacent. Really interesting problem, massive problem. Like if anybody's bought a home and gotten a mortgage, it's a pretty painful process. It takes a long time. I think a lot of the reason why mortgage and home finance in general is behind the curve is because it is such an infrequent interaction. But effectively, what we were doing was allowing home buyers to make more powerful offers by backstopping mortgages with cash offers. And at that time, this was 2020, the market was hot, interest rates were super low. This turned out to be a great time to start a mortgage company. We had moved to Austin, Texas, just because that was the easiest place to start a mortgage company relative to Boston, Massachusetts. And I ran capital markets and product there. The product itself was very much like financially engineered, and so it played into my background, having come from finance. But that was really kind of the start of my journey into early stage, and gave me the confidence to then go and start Abode Money in mid 2023. And
So
we are.
before we get into a boat, I'm curious a couple things on this journey. So for one, did you, growing up and going through the big finance experience, right? Did you sort of have a sense that you wanted to eventually get onto the operator side and start a business, or when did that become apparent?
No, I didn't have a clue. When I went to Notre Dame, I wanted to be a radiologist, just because I knew they made a lot of money. And then turned out like, yeah, medical school is
Then you
hard.
saw Madison Dearborn Money and still said no to that. Yeah.
So no, I didn't have this grand vision to become an entrepreneur. Um, I think like it first really came again when when I spent a summer in venture, you kind of sit across the table from other entrepreneurs. And again, not everybody has this view. And I think there's great investors that don't have operating experience, but I was like, why am I talking to this person on the other side of the table and kind of, you know, why do I get to grade what they're doing? I have no understanding of what they're going through. And from a self-awareness perspective, I was like, I kind of want to have that experience to be able to kind of take myself seriously. And that was where
I've
I was.
always said, as a VC for me, I felt like I had very valid imposter syndrome because I could just look at metrics and say, are they growing fast enough? Is the LTV to CAC strong enough? Is the gross margin okay? I had no idea how companies actually worked on the inside, and I felt so bad having to tell founders that they weren't meeting the hurdle that we set when I had never built anything myself. The experience was so obviously lacking for me.
Yeah, yeah, and so I came out of that experience being like, okay, I dug into fintech. I think fintech was always interesting to me. It felt like it was behind the curve of technology, broadly speaking, and really out of happenstance, I was introduced to Tim and Lewis, who were two of my peers at HBS. They had just gone through YC. They had just dropped out after our first year, and I started working with them through a project with Jeff Busgang, a professor at HBS who's known for a lot of he runs a VC called Flybridge as well. He's great. And so I worked with him and, we were in a one room, four white walls in Harvard Square, kind of just like doing the startup thing. And I thought it was really cool and it was intoxicating and it was exciting and it felt like the time to take a risk. And, that was 8 years ago. So, and here we are.
And how long did you stay at UpEquity? How did the company evolve in that time?
I was there for the better part of 4 years. We started off
You started off in four walls with three people, right?
And right
By
before
the time you
COVID,
left.
right before
Jeez,
COVID,
right.
interestingly. So this was January of 2020 when I officially joined after kind of working with them the semester before, and then things went offline and business school itself went online. So I was just like, okay, maybe I'll just start working with these guys full time sooner. And so I spent 4 years there. I saw how the fundraising process was done. I worked really closely with the CEO on that. And then building out a product when, when you're a seed stage company, you're still figuring out a lot. The technology's not all the way there. You kind of see that you do have to build a plane while you're flying it. Otherwise, you're just going to get left behind. And like I said, the technology side of things or the product side of things was very much financially oriented. I mean, the mortgage is a very complex process. Fannie and Freddie guidelines is a 750-page living document that changes all the time, has more edge cases than it does not. And this was also before the time of LLM. So now you address this problem and you can kind of see how the use case is very, very obvious. But at the time, it was like it was and still is a very difficult problem. But you have to know the regulation very intimately in order to build a solution that's very innovative, because what I've learned in financial services is that you can't operate outside of regulation. You're just going to get stonewalled. It's just a bad idea. But you still want to be able to innovate. So how can you innovate within the guidelines of regulation? That was the massive learning that I had when kind of running product at UpEquity. We built a lot of really interesting things that I don't think a lot of mortgage lenders will replicate, just because it is an increase in the risk tolerance that you're willing to take. But if you're smart about that and you're smart about how you manage capital markets and risk, it can definitely be done. I just think the benefit of being in that space was that mortgage companies do not innovate. They do not move fast. And, we were looking to do that. But there's a lot of reasons why there's kind of these barriers to entry that are very difficult for startups to disrupt.
Yeah, it's something I've seen play out again and again. Just if you are a founder thinking about what space to go into, right? There is pros and cons either way, because spaces that don't have a lot of innovation and have a lot of kind of fat, happy constituents doing things the traditional way, you can stand out more, but there's a reason why they don't innovate in some cases that you will run into. And so, it can be great. It can also be really challenging. By the time you left UpEquity, how much had the business grown?
Well, we had at our peak, we had raised over $100 million. or Series B. Part of that was credit facilities, the debt tied to issuing mortgages. 100 people at our peak, and the company was on fire. Unfortunately, obviously, go back to 2022. That was late 22, early 23 was when rates started to rise, tech pullback started to happen. So both of those things kind of hit us at once. We had to go through 2 or 3 different rifts, which were not easy at all, especially since we had such a big team. At that time, this is also when AI started to become a thing. So that's when I started to think about leaving. But the company, UpEquity, has done phenomenally well weathering the storm, and now they're valued twice as much as when I left, and doing really, really incredibly well. So it's a lot of credit to Tim, the CEO over there.
That. And yeah, it's a good segue because uh, it sounds like part of your decision to leave was based around the notion of why now and seeing an opportunity that was kind of timing specific to do something new. So tell us quickly about your sort of vision with Abode and why you got excited to leave a very cool company and start this new one.
Part of it was just like I felt like I wanted to be the decision maker, and I wanted to attach my name to something because I saw how cool that was from UpEquity. But I was not a founder. I was the first employee. So a little bit was just like I want to go and take this jump. At the same time, I also bought my first home in 2021. Went through that process, and I was running finance and a mortgage, like at a mortgage company, and still was kind of thrown into the gauntlet of all these costs that you're very unfamiliar with. So that was a pretty eye-opening experience. And then, that was the advent of like ChatGPT coming into the limelight, and you're like, wow, this is a really cool technology. This has real application that you can kind of see, and you're kind of just like, this is a moment in time where I kind of want to just go and immerse myself in this arena to learn as much as possible. So those 3 things kind of combined made it the right time. And I found an investor who wanted to work with me, like kind of like to get me to de-risk that start for me, to kind of put up a seed check or a pre-seed check before I even started the business. And so it was a pretty de-risked, like no-brainer at that point. It just became, a difficult conversation that I had to have with leadership at UpEquity, but that was definitely something that I wanted to do.
Um, and Abode, I mean, I think we first reconnected back when I assume, had already raised the pre-seed, maybe, or we're wrapping that up, but it was early on. And I remember feeling no surprise at this, but being so impressed with the way you ran the first fundraising process that I had any exposure to. And I think there are a lot of things you did really well that other founders could borrow from. So I'll call out a couple things I saw specifically, and then you add what else I'm missing. But the first thing I remember is when we reconnected and I heard the vision, I said, I'd love to make a couple intros to investors in our network. If helpful, let me know what you think. And you sent me back a Google Doc that you had already planned out exactly like, these are the investors we want to go raise money from. We know they're good fits. We know we would want them on our cap table. And I've already got a long list of people that can provide intros to each one. So it was like, don't intro me to whoever you want. These are the investors I want. And if you know any of them, please do make introductions. But that advanced planning of, I know who I want to back this business and I'm going to find a warm introduction to them through my network, I thought was excellent.
I mean, yeah, I can't take credit for like my inception of that idea. I took it from another founder, but it definitely is helpful, and it kind of like shows you, the process itself is pretty important. Yeah, I think like a couple of the foundations or mantras of fundraising is like, you want to be introduced to decision makers, partners, not to diminish the role of an associate or a VP, but if you're not making a decision, then you're kind of just, if you can go straight to the source, to the decision maker, that's always going to be more helpful. And intros matter as well. VCs see hundreds of pitches a week. And so you do need to stand out. Intro going in cold is, you're already kind of like starting off a little bit backpedaling. You need to get an intro that is from, ideally there's like a hierarchy, but like ideally it's from a former founder. Even better if that founder had been backed by that investor. But founders are the best intros because, founders don't want to put their name next to somebody they don't believe in, and you're already kind of like respected if you're a founder and you have those intros available to you. And then, my existing investors, because especially if they're also putting in money, it's just like this big snowball. So I think there's like anybody going through the fundraising process, it is pretty grueling, and you should set up the process such that you're having 40, I think for that round, I had like 60 meetings in 2 weeks. And it's just like,
That's a key thing that I want to pause on too, because where people make the mistake, in my experience, is opportunistically take introductions and have calls when you can get them. And you need to create some real urgency and competitive dynamics to run a process effectively. So what you did is spent a lot of time sharpening that axe by lining up your introductions and getting the target list together. And then you have 60 conversations in 2 weeks. And now the process is off to the races, and people need to move fast on the investor side if they want a piece of this.
right. I mean, you're kind of just playing into the fact that, VCs are essentially a money manager for the earliest stage of companies, and they're looking at hundreds of companies. So you kind of need to play into the idea that they need to see the FOMO from their end. And so how do you do that? You stack a lot of conversations into a short amount of time such that you can kind of like leverage the ones that progress to like tell others like, hey, this is moving fast. Because VC is not private equity. It's not all quantitative analysis and models. Like, I don't even know if VC is really,
Very little. Yeah.
I may offend some people, but I don't think VCs are actually using models. I think they are just really looking to pattern match on what they know works. They're betting on the founder, they're betting on the team, they're betting on the market size. And at a seed stage, you're kind of betting on the product or the idea of the product. But a lot of those are very qualitative, kind of hand wavy things, but the best investors kind of know what to look for. One of those things is other signal from investors. And so if you can kind of get to a point where like you're saying, okay, these investors are in, you got to move fast or you're going to miss out on this opportunity. It's like a weird game theory gamesmanship to it, and it's kind of fun, when it's working in favor. It's annoying when it's not, but
yeah. And in addition to the FOMO and the signal of like everybody wants to follow investors they respect into the same deals, there's also just this notion that there's so much uncertainty at early stages that if investors don't need to put the check in right now, they're better off dragging you along and saying, let's catch up in a few weeks. How are things going now? Whatever. So they can just wait to get more data and see if you're performing the way that you thought you would before they go commit. So creating some urgency is so critical. The second thing I remember from your pitch is I don't know, do you know Jackson Jin? He's a fellow Notre Dame founder and a good friend of mine.
yeah, I do. He was
Yeah.
at Cameo. I met him
Yes.
briefly.
Shout out Jackson, great guy. And he, when I was first raising for Opstart, gave me some fantastic advice around this, but you have to kind of sell a grand vision. You start with this big, massive, world-changing problem and opportunity, and then you can kind of parse it down to what specifically you're going to be doing within it, right? And I think you immediately resonated with at least me, and I imagine most people who see your deck, by starting with this notion of like homeownership is so administratively challenging and boring. There's so much around it with insurance, with taxes, with maintenance that is really difficult for people that want to become homeowners, and technology is not solving this for them yet. And, by the time I got to slide 2, I was already totally hooked.
Yeah, I mean, I think I reference DoorDash. Tony Zhu is always like, DoorDash is like last mile logistics company. They're just starting with food delivery. Everybody thinks of them as food delivery because that's the immediate use case. But what we're really doing is building this infrastructure that is this massive, like they're FedEx. They want to be FedEx. And so for us, like our grand vision, Abode Money is an AI financial manager for homeowners. What we're going after is, I think, the largest untapped opportunity in all of consumer, which is creating a relationship with homeowners. If you think about it, there is no one that has that ongoing relationship with homeowners. But there's a reason for that. It's a very competitive space, and it's difficult to get people to care, right? Especially, and not just care, but also pay you money, care enough to pay you money. And so you can't just go out and boil the ocean and say we're going to do all of these things, because that's just a recipe for disaster. And so what we found with property taxes, that is just the single best way to wedge into that homeowner relationship for a number of reasons. One, you pay a lot of money in property taxes. I think in the US, the average property tax bill is near $5,000. In Texas, it's probably close to $12,000, where property taxes are higher. Two, everybody hates taxes. Nobody wants to pay more taxes. I haven't met somebody that doesn't want to pay less taxes. So you kind of have baked in product market fit if you can make it work. And then three actually is there's no onboarding experience. All we need is public data and your approval essentially to move forward with a property tax appeal is what it's called, which is beautiful because we're not competing with attention. You're not having to go through this massively long onboarding process. And then lastly, there is no national solution. And there's a big why now element to why we are the first property tax appeal company that exists in all 50 states, which we can get into. But the reality is we're going after a white space where around 74% of homeowners can save on property taxes, but only 4% are actually doing something about it because of the complexity, because of the unfamiliarity. So we wedge in and say, hey, we can save you thousands of dollars a year, right? You don't have to do anything except for sign up. And then we win that credibility to then say, okay, now let us help you save on insurance and utilities and private mortgage insurance and all these other things. But we don't have to start off cold. We're saying, hey, we're going to go do this for you to earn your trust, to earn that credibility.
100%. Yeah, it's an incredible model. And I think obviously for the reasons you said, property tax is such a great wedge to get in the door. Anybody who is a homeowner, I've filed my property tax appeals manually and had to ask my neighbor who happened to be a lawyer how he did it and whatnot. It's brutal and there's so much you don't know. But in addition to picking the right wedge, you probably picked the perfect time to start this business as well, which you just sort of hinted on. So was that the advent of AI told you that this can now all be doable in a way that wouldn't have been possible without a human in the loop under a SaaS architecture?
Yeah, I mean, this gets into the weeds a little bit, but AI, there's kind of three big components to why property tax appeals could not be done outside of a localized level. This is an industry, a niche industry that exists in regional levels like Central Texas or covers New Jersey or, covers Cook County, Illinois, but you don't see these companies exist on a national level for a few reasons. One, the data that you need to be able to kind of build a case to say, I should pay less taxes, you're overvaluing my home from an assessment level, is very antiquated, is very localized. There's no single data provider, and you need to be able to get retrieve county level data to be able to make that case. Doing that is very difficult. It's not just building comps on sales transactions. It's very different from that. So we're using agentic AI to be able to retrieve and normalize that data to be able to make sense of it. The big one that is really defensible, number two, is every county, there are 3,143 counties in the US, and every county wants to see the way that you present that evidence differently. They in Miami, Dade County, they have wet properties and dry properties, and that needs to make its way into the evidence. In Texas, they have neighborhood codes, and so you need to take into account different neighborhood codes and how to adjust the numbers for the way that they want to see them, because this is a little bit of a corrupt practice. These governments want more money, and so they want to prevent you from being able to do this. They're going to use these things as an excuse to be able to throw out your case. And so what we're doing is we're paying property tax consultants in every single state that we go into $100 an hour to record calls and just download their brain into a knowledge base that then we can query with AI. And then the last component of this is the fact that there is a last mile manual component to property tax appeals, which is needing to submit the appeal package to the county at the right time in the right place, and then to go and make your case with the county. A lot of property tax appeals are done by professionals that'll actually argue with the county on your behalf. That is a component of what we're doing, but that is where AI can automate a lot of the process to the event where a property tax appeal consultant from an incumbent can probably handle 1,000 appeals a year, ours can handle 25,000. So we're just making that manual. We're not taking the person out of the process. We're just making them incredibly more effective.
And does that person who's working with you then benefit and become a paying customer? Or do you just monetize on kind of the end consumer side?
We monetize the consumer, but for the property tax consultants that are working for us, it's beautiful because we're doing 90% of their job with data and automation. So they're able to do more appeals, make more money, and like honestly work less than when they were working for another company. So in a lot of ways, we're creating this marketplace where we can pick and choose the best consultants to come work for us, and they're getting a much better deal by working with us.
It's amazing when you find an opportunity like that where everybody wins, where the incumbents benefit from your success and they then promote you as a result of that can be just a massive, massive boon to growth.
Right.
Yeah. So you guys start working on the property tax problem. If I recall correctly, you generally just started in your local Austin area, expanded to Texas, and then now you said you're live in 50 states.
Yeah, it was a big jump. It was a big lift for my product last year. Basically, the entire second half of 2025, we decided that, it was a little bit of a complication in doing Texas where we had this last mile issue and we needed to vertically integrate. And in vertically integrating, we also built a lot of the technology that would make this portable to not just Texas, but all 50 states. The reason this doesn't exist in all 50 states outside of the AI component to it is just because, unit economics don't necessarily make sense to send a person into a lot of these places with lower property taxes. So now we're doing that with mostly automation. It costs us $2.50 to run an individual appeal where it costs, our incumbents $40 to $50 in labor costs. So we can afford to go into a lot of these areas that are not as attractive for, the yesterday's property tax company. But it was like the plan was to kind of roll out sequentially from like Texas to like the next 10 states, but we found a way, and the pace of technology has
Do
been
all
crazy
49 more. Yeah.
that we feel like we can kind of build in the adjustments and the scalability to our model to be able to address every locale. And I think, some of that is definitely attributable to just the acceleration of what AI can do, which has been pretty crazy, especially over the last 6 months. It's been wild. So part of like what we need to do is now build like 6 months in advance for where AI is going to be in 6 months. Otherwise, you're kind of building things that are going to be made obsolete.
I think I speak on behalf of a lot of founders when I say, how do you do that? How do you know where AI is going to be 6 months from now and try and anticipate that the right way?
I mean, that's what makes it fun right now, right? Because like definitely more art than science, and it's kind of just like I think it's attributable to two things, and this is how we hire. Is one, you kind of just need to be like, you need to have your finger on the pulse, right? You need to know what's going on. You need to know like, right now the flavor of the month is like OpenClaw and Claude Code, and the advancements that those tools have made over the last 3 months is incredible. So just like knowing what's going on is definitely helpful, and having a little bit of like an opinion or a crystal ball. The other is just being creative and experimental. Like a lot of the times you can take a tool here and a tool here, and 1 + 1 = 3. It takes time to like experiment, and you're going to hit a lot of dead ends. But I think you kind of need to be intellectually curious or AI curious in order to know like how to build ahead of where things are going. I mean, an example is, we are following these negotiations are done via virtual hearings or phone calls with the county, which is part of what we're using humans for. But I think eventually voice AI gets to a point where it is very, very, very sharp and efficient. And then I think like, you also need to predict where regulation is going. Where are the lobbying dollars? Is it going to be possible to have an AI avatar take power of attorney on behalf of a homeowner in the future? Or is that going to be something that's regulatorily like a massive headwind? And we're assessing that, but that's where we see this going. And then that's another example of kind of like thinking about where some of these technologies are going.
That's wonderful. I also love how you framed the hiring thing there. One of the things I've learned here is if you are hiring early on, figure out what you're comfortable teaching someone and what you can't teach them. And curiosity is one of those things you can't teach. So look for people that have the existing curiosity proven in the space. You can teach them about property taxes. They might not love it, but you can probably teach them how property taxes work. You
Everybody on
can't
my
teach.
team loves property taxes.
There you go. Who doesn't? Um, but yeah, I think that makes a lot of sense.
Yeah,
Um,
I hear what you're saying.
because you're a fellow finance guy, nerd out for a second here. What are the decisions in scaling that rapidly that you found that have been the biggest unlocks in doing so with capital efficiency, right? Like where did you figure out you could save a ton of money and expand more quickly or better monetize your customers, flip the cash conversion cycle to get, you know, cash in sooner and burn less? What has been some of your biggest unlocks there?
Um, I think one of them is an arbitrary mentality that we should be able to automate anything done by like manual services operations. We should like really try hard to do that with automation. So it's somewhat like constraint breeds creativity in that regard, where I set out to build a company and I basically said, I don't want to throw ops people or salespeople or headcount at these problems. I want to hire really, really, really smart engineers who have this level of AI curiosity to be able to try to problem solve around doing what was done once a service and turning that into
So the
software.
more expensive hire up front creates a ton of leverage at scale because they can do the work that would have otherwise taken 10 cheaper hires, right?
Yeah, I mean, we don't want to recreate the wheel and like just throw AI at it just for the sake of AI, but a lot of these
Clearly.
things break convention, right? I think a lot of why financial services is slow is because there are natural barriers to entry and things have been done the way they've been done for the last 30 years. We did this at UpEquity and we're doing this at Abode Money, which is like we don't hire from the industry. I don't want to hire from any of my competitors, whether they be like, upstart competitors or like competitors that have been around for 30, 40 years, because I want the fresh perspective. And we can leverage those folks to the extent they have domain knowledge, like you said, but those folks are likely not going to be the folks that are the most innovative and ahead of the curve on like the technological aspect. So we're hiring folks not from the industry because they bring a fresh perspective. So it's very intentional in that regard.
That makes a lot of sense. Um, Future vision for Abode. You touched on this a little bit, but you guys found an amazing wedge with property tax. It seems like that is working well in getting you into, a bunch of homes essentially, and integrated with the homeowners. But there is still so much opportunity there now that you're in. So how do you balance the notion of you probably still have so much room to grow within property tax alone, but you're really curious about attacking PMI and attacking, home warranties and things like that?
Yeah, I mean, the beauty is like we've sized bottoms up the property tax market for us is a $10 billion opportunity. So I could build $10 billion business just on property tax, but we didn't set out to build a property tax business. I think it is about this extension of the homeowner relationship. Like if you own the homeowner, that is a very, very, very powerful place to be, because I don't think that anybody owns that relationship to date. And if they trust you, right, then you can kind of be the one to sell them into other things or proactively monitor their finances for other opportunities. One of the things I think about is like, I think lead gen in all forms is a terrible user experience, but especially in financial services, it's a terrible user experience. I want to basically just disrupt lead gen. If I create a relationship with you as a homeowner and I've saved you money on property taxes, well, when it's time to shop your insurance policy because it's 60 days out from renewal, one, that's something you should be doing. But two, if I've already saved you money and I tell you I can do this, why would you go and enter your information on some like lead generation aggregator when you can just have us do it for you? Not only is it going to be less work and you're not going to get spammed, but we've already proven that we have your best interests at heart. And I also don't need to recreate the wheel to offer you insurance the same way I had to kind of recreate the wheel to build property tax. So the asset that we have is the fact that it's so incredibly expensive to acquire the audience that we're acquiring with property tax. And then we will just extend out from there into insurance savings and shopping, and then utilities, where you can actually switch your utility plan in like a third of the states in the US, and then going into mortgage, which also accounts for private mortgage insurance. All of these things add up to about $30,000 to $40,000 in spend per year. And if you're paying Abode Money $99 a year, it is a little bit like one of our users, early users, called it an insurance policy against overspending, or an insurance policy against doing the wrong thing. So it's like this peace of mind element. And that's phase two. It's like a massive, massive market. We've sized that at about $125 billion market once you extend into the entire suite of home spend. But to take it one step further, again, we have the trust of a homeowner at this point. What are the other things that are financially related on a homeowner's plate? Not necessarily related to the home, but if you're a new homeowner, you're probably maybe starting a family. And so you should start thinking about life insurance. If you're an older homeowner, maybe you're thinking about estate planning, trusts and wills, these types of things. In the middle of both of those life events, you're probably thinking about banking and lending. And we're really, at the core, we're really just demystifying overly complex financial elements that financially savvy folks should be doing. And again, it
so much gatekeeping in these worlds, right?
It all starts with just the trust of knowing that you're on the homeowner knowing you're on their side. You're not trying to sell them something, which is why we monetize via subscription, because then we're going and basically like making the right decisions on behalf of the homeowner, regardless of if it gets us paid.
Your incentive is just they keep paying for the subscription. It's not that they do everything you're marketing to them through the subscription, right?
Right. If I spam you by selling your lead, which we could do and make a lot of money, I'm going to lose you. And then my LTV gets shot because you're going to churn, right? Our entire business is based on this recurring relationship with you. And so we're never going to do anything that's not, aligned with your interests. And I think there's that doesn't exist today outside of, a significant level of affluence. Like, there is no such thing as a financial manager for homeowners, and you're doing all these things that are incredibly complicated. I mean, I don't know anything about life insurance. That's not necessarily related to the home, but that's something that should also be demystified because it benefits you at a certain point.
You're right. It's so transactional. I bought my first home in 2022. We moved 6 months ago, roughly. I didn't know who owned the mortgage for our first home anymore. I couldn't remember the name of the person that sold it to us. Property taxes, like I said, I did with my neighbor. I didn't remember who our insurance was through. There's so much of that you just have to dig through old documents to find out and try and get a hold of someone who now no longer has something to sell you and doesn't really care that much anymore. Yeah, it's just another reason why I find this opportunity so exciting.
Yeah, our biggest competition is just unfamiliarity, right? It's like we're selling into a relative white space right now, and our biggest hurdle is educating the homeowner that they should be doing these things. And so we try to say, educate, then automate. We educate users on the things that they should be doing. And then we say, okay, here's an easy button that we're offering for us to just go do that for you. But realistically, a lot of homeowners think that this stuff is just set and forget. They're like, oh, my taxes are what they are. The government tells me what I need to pay, and I'll just pay that. And with insurance, it's like, I don't know anything about the policy that I have, but I got it and it seems to be working. I definitely don't want to mess with it. But the reality is, if you do know how to kind of navigate that process, you can save a lot of money, especially on insurance, the way the premiums are going. And this extends into these other elements of homeownership as well.
I mean, it's a nice place to be when you've got green space in all directions. You could expand within your existing customer relationships. You've got tons more households to get to, and you could be monetizing those, as you said, through partnerships with people that need that data, for lead gen purposes. So yeah, that's a lot of excitement ahead.
Yeah, it's been fun.
What would your advice be for people who out there who, maybe come from backgrounds like us, of you're at a good university, you're working in a big corporate finance type of job, you're interested in maybe taking that step to become a founder? What would you say to those folks?
Well, I think the most recent advice that I definitely believe in is just kind of get to know AI. It can make you so powerful. I think, I'm the least technical person on my team, but I'm still monitoring at which point does it make sense for me to start actually learning how to code, and not just because there's a lot of tools out there where you can just kind of talk to an interface. That's not yet coding, but maybe it soon will be. And then there's actually getting to know Claude Code. The barrier to entry of like, my background, your background being financially oriented, which is not the most applicable skill set for a startup. If you think about the normal startup, is becoming more relevant because the curve of like technological product acumen is being flattened by AI. So that's one, is just kind of like get in there, experiment, start to play around, because you can now launch things in months that used to take years with, thousands of dollars where it used to take millions of dollars. Um, but the other that is kind of like more longstanding advice would just be to kind of like go work for a startup. I think it's difficult to kind of like just go from straight finance to starting a company. Not to say it can't be done. I benefited massively from just seeing how UpEquity was built. I have a complete and total buy-in for why VCs prefer second-time founders over first-time founders, because you kind of see like all of the problems that are thrown at you and how to kind of solve those problems. I mean, that's like my entire job for the last 3 years is just solving problems that get thrown at you, because more often than not, you're just putting out fires and trying to enable your team. And if you see those things happen before, it's much easier to solve for them. So it's just like find a way to get yourself in the door and see how they work. The earlier, the
I
better.
selfishly love like working with second time founders at Upstart now, because when I talk to a first time founder and try to explain what we do, the first question is generally like, well, do we need that? Like what do we actually need here? What does all of this mean? And I totally get that, there's no shade on them, but second time founders, by the time we get on the call, they're like, yeah, I know what you guys do. I know we need it. If you can just tell me why you're the right person to do the job versus others, then it's a no-brainer. I know that we need it already, and that makes it a lot easier.
Yeah. So like, I think that there is, I think anybody that wants to go start their own company should work for a company of less than 10 people, because like the delta between a company with less than 10 people to like raising an A and then, growing up into a real company, I think is night and day. And you just learn there's a lot of the intangible things that we talked about, from just, knowing how to address problems, knowing how to communicate, knowing how to, again, like just
Prioritize,
figure
right?
stuff out, build the plane while you're
Yeah.
flying it, like fundraise, all of those things. There's so many things that are just underappreciated if you work at a Series A or later company or corporate, that just don't exist when you're starting a company from absolutely nothing. And it's just, yeah, it's hard. So the more exposure you can get to it at the earliest stage is going to really benefit you from like a cold start finance background.
Yeah. And you just mentioned Series A there. So can we talk about your plans on that front?
Yeah, we'll probably launch our Series A this summer. We're growing really quickly right now. Since we kind of did spend the latter half of 2025 building a lot of product, we're now like in full growth mode, growing 40% a month. And I think we're right at the median level for Series A metrics in terms of top line. But I still like, we have plenty of runway and a few things to prove out. The only consideration is like how fast is the AI landscape moving around us, and that may shift things up or shift things back. But yeah, we'll go out and raise, probably 10 to 15 million and look to really just like expand deeper into all 50 states, and then start to really lean into some of these other products that we want to get into.
There's a final piece of advice for founders on the fundraising front that is really good. You always want to be raising because there's just a one-time opportunity to go faster, not because you're out of money and desperately need it. If you can get yourself into that position of power like Tyler has, then you are in really good shape.
Yeah, it's a very interesting time, especially given like the recent acceleration on some of these AI tools, and just like there's also macro considerations, right? Like there's a couple headwinds that I don't need to like name that are very obvious to what's going on around us, where that does have trickle down effects to the funding environment. So right now, like the best thing we can do is continue to just execute and do what we're doing and like delight our customers and grow. But very soon it becomes time to kind of zoom out and go back into that CRM and get my schedule of calls teed up for a 2 to 3 week sprint.
Well, thanks again for doing this. I really appreciate the time. And if you make it back home to visit the folks in Granger and South Bend, let's get together in person.
Yeah, perfect.
All right.
Appreciate having me on, Paul. This was
Yeah.
fun.
Thanks again, Tyler.
All right.